In January 2019, WeWork was valued at about $47 billion. That put it in the same emotional category as the great technology companies of the decade. Investors looked at it and saw a revolution in the future of offices, community, and work. But here is the strange part. WeWork did not sell software or build search engines, smartphones, chips, or cloud infrastructure. At its core, WeWork leased office space for a long time, redesigned it, and divided it into smaller pieces. It rented those pieces out for a shorter time. That was the whole tension of the business. The company was priced like a technology platform, but its biggest bills looked like real estate. Rent did not care about the story WeWork told. It arrived reliably every single month. To understand WeWork, do not start with the bankruptcy. Start with the feeling it sold. After the financial crisis, work was changing. Freelancers wanted flexible desk options. Startups did not want to sign traditional office leases. Big companies wanted satellite offices without long commitments. A clean, energetic co-working space made perfect sense for all these groups of people. Adam Neumann and Miguel McElvey founded WeWork in 2010, and the basic product was genuinely useful. You could walk into a WeWork and feel that work had become lighter, with glass walls, shared kitchens, and fast internet. The office did not feel like a corporate lease. It felt like membership in a movement. That was powerful, but a useful product is not the same as a $47 billion company. The question was never, do people like having access to flexible office space? The real question was, can this business scale like technology while carrying the obligations of real estate? That question would eventually break the spell that WeWork had cast on its investors. The WeWork machine was simple on the surface. Sign a long-term lease with the landlord. Spend money building out the space, fill it with members, charge those members enough to cover rent. The charges cover operations costs and the cost of expansion for new WeWork locations. If occupancy is high and pricing is strong, the WeWork business model can work well. But notice the mismatch. WeWork was often locked into long-term lease obligations. Many of its customers wanted flexibility. They could stay, shrink, move, or leave quickly. They could leave much faster than WeWork could escape its long-term rent bill obligations. That is a dangerous shape for a business. Imagine renting an entire apartment building for 15 years, then offer tenants the ability to leave their rental agreement after just one single month. When everyone wants in, you look brilliant. When demand weakens, you are still holding the keys. During the boom, the story covered the risk. WeWork talked about community, network effects, data, design, and a global platform. SoftBank became its most important backer, pouring billions into the company through the Vision Fund era. Growth became the proof of the dream. More locations meant more members meant more brand power. More brand power meant investors could imagine a future where WeWork was not just renting desks. They imagined WeWork would be controlling the operating system for work itself in the future. That sentence sounds exciting to investors, but it also has one very small key problem. The operating system for work that WeWork was building still had to pay rent every month. When the We company filed to go public in August 2019, the public market finally saw the details. The Sus-1 showed rapid revenue growth, but also huge losses. For 2018, the company reported a net loss of about $1.9 billion. For the first 6 months of 2019, it reported another large net loss for that operating period. The filing also made the lease risk harder to ignore. WeWork itself warned that if members left a space and could not be replaced, lease costs could exceed revenue, and the company might not be able to reduce or terminate the rent. That was the quiet sentence underneath the loud brand. Growth was real, and the risk was real too. Private markets can reward a story for a long time. Public markets are less romantic. Once WeWork's IPO filing became public, investors and journalists started asking a different kind of question. Not, how big can this get? But what exactly are we buying? The answer was messy. There were concerns about losses, concerns about governance, concerns about related party transactions, concerns about whether the company deserved a technology multiple at all. And then there was the language. WeWork had used adjusted metrics to tell investors that mature locations could look attractive. But the more complicated the presentation became, the more the public market seemed to focus on the basic math. Long leases, shorter customer commitments, big build-out costs, heavy losses, a charismatic founder with extraordinary control. The IPO did not just stumble, it unraveled. By September 2019, the offering was delayed. Adam Neumann stepped down as CEO. The company withdrew the IPO filing. SoftBank had to step in with a rescue. And WeWork's valuation was cut dramatically from the $47 billion private market peak. That alone would have made WeWork a legendary failed IPO story. But the business still had to survive the real world. Then COVID hit. Offices emptied. Companies reconsidered space. Remote work became normal almost overnight. Even when workers returned, many employers wanted more flexibility, not more commitment. In theory, that should have helped a flexible office company. In practice, WeWork was still carrying the weight of older leases, signed for a different world. The company eventually went public through a SPAC in 2021 at a far lower valuation than the 2019 dream. But the pressure never really disappeared. Higher interest rates, weaker office demand, and expensive leases kept squeezing the business. In November 2023, WeWork filed for Chapter 11 bankruptcy protection. In the US and Canada, the brand had survived. The old capital structure had not. WeWork emerged from Chapter 11 in June 2024 with new leadership, a restructured balance sheet, and a much more sober identity. That ending matters because WeWork did not simply vanish. The service still has value. Flexible office space is useful. Companies still want ways to avoid signing traditional leases. Workers still like good locations, easy access, and professional spaces that do not require building an entire office from scratch. The mistake was not that co-working was worthless. That is the lesson. The mistake was pricing a real estate operating model as if it had the economics of software. Software can sometimes scale with very low marginal cost. Real estate does not behave that way. Add one more user, and the product may barely cost more to deliver. Every new location requires space, construction, staff, utilities, maintenance, local demand, and time. In software, growth can make the machine lighter. In real estate, growth can make the machine heavier. WeWork's story is also a warning about vocabulary. Platform, community, ecosystem, future of work. In every market cycle, investors find words that make old risks sound new. Those words are not automatically wrong, but they can become a fog machine. They can make a company feel more scalable, more defensible, and more inevitable than the underlying numbers support. The boring questions are usually the important ones. How long are the obligations? How stable is the revenue? What happens if demand falls? Who pays when the story slows down? Its fall came when the market finally separated the two. WeWork's rise was built on a genuinely attractive product and an even more attractive narrative. The company sold flexibility to customers, but on its own balance sheet, it had very little flexibility left. The most dangerous businesses are not always the ones with bad products. And that is the part every investor should remember. Sometimes they are the ones with good products, huge stories, and financial structures that only work while everyone keeps believing.